Welcome back to Requity Insights. Today I'm joined again by Dylan Marma, the CEO of the Requity Group. On today's episode, we are having a discussion on the current state of the commercial real estate market, with a particular focus on capital markets and the acquisitions landscape.
Welcome to Requity Insights, a channel dedicated to documenting our journey to 100 world-class communities.
To kick things off, Dylan, can you give us an overview of the Requity Group's current investment strategy and areas of focus?
Yeah, sure thing, Luis. So our current investment strategy has really not changed all that much in the last 12 months, though the amount of deals that have made it through our filter has certainly changed. Our main priority is to target both RV campgrounds and manufactured home communities primarily in the Southeast and the outskirts of the Southeast that have a value add component to the execution of our business plan to be able to hit a target return somewhere in the mid to high teens IRR on say a 5-year timeline. But usually our overall goal is to go in and purchase the property, create value with the opportunity to also refinance the property to return capital and continue to hold long term. So that's been our strategy for the last 3 years, really, and our focus has remained overall the same. And I'd say that in the last 6 months or so, and covering as we touch on some of the stuff that relates to the state of the market, I think we'll get into where we've been able to try to identify maybe some more pockets of opportunity or find some strategies that make it a little bit easier for us to find something that might make sense.
Okay. So I think for today's discussion, we're trying to take like a 3-part approach. We're going to try to approach the market from a capital markets standpoint, from an acquisitions, and somewhat of a management standpoint. On the capital markets front, I know that they play a crucial role in real estate investment as a whole. What sort of changes have you seen and what impact have they had on TRG's investment strategy?
Yep. So looking at year to date, we have closed on one opportunity and we've evaluated several hundred opportunities year to date. And even the one opportunity we closed on was one that we identified as of late last year. So being that we're tracking well over 100 deals underwritten each quarter, we certainly have seen a pretty significant amount of deal flow still. But again, I think there's just been that pricing disconnect that us and a lot of our peers are all sharing. Now, a lot of that pertains to what we're going to discuss, the capital markets. And primarily, the big elephant in the room is just interest rates and being able to factor in where new rates are. Well, the sellers generally want last year's prices. So we've struggled with that quite a bit ourselves. On the debt side, we've seen lender spreads increase in addition to just the general benchmark rates increasing. So it's led to rates being significantly higher than they were a year ago. And I think a lot of sellers are not coming to terms with reality in the sense of that there has been pricing adjustment, and a lot of them are still hoping that they can get out at last year's prices. So that's what we're up against for the most part, and we'll hit on some more as it pertains to debt and equity.
Okay. How does the increase in interest rates impact our existing loan obligations, perhaps in relation to possible refinances and also looking ahead to future acquisitions?
Mm-hmm. Well, thankfully, right now we have, I believe the shortest fuse we have on any of our loans is 3 years from today, and we have fixed rates across our whole portfolio. So we aren't in a spot at this moment where we have to refinance anything or we have anything that's near term ballooning. So for the most part, when it comes to refinances, we're really just focused on adding value, pouring in on operations. That's really been the theme of this year for us, is just pouring into the existing projects, making sure that they're all optimized to the highest capability, trying to really just make sure we're getting our returns where we set the expectations or above for our investors. And in terms of refinancing, that really is not a big priority right now, as I think we are under the mindset that, likely in a few years we may be in a different environment. We may be lucky to see, late rates sort of normalize, but I think it's going to get uglier before it gets better. So we are just proceeding with caution, certainly. And then in terms of securing financing on new deals, we definitely are looking at a lot more seller financing these days, because no one wanted to hold a note when their competition was giving us 3 or 4% interest rates, whereas now, being able to offer a seller a 5 or 6% rate and still that being 200 basis points, say, lower than where the market is right now, makes it a little bit more of a win-win. So we definitely are making a lot more offers that have seller financing included these days.
Okay. So kind of touching on what you mentioned, given that the economic outlook appears a little bit less favorable or more uncertain, what strategies are you employing to mitigate those potential challenges? I know you mentioned seller financing, but are there any other strategies that we're kind of deploying at the moment?
Yeah, so my view right now is we haven't changed our standards at all in terms of what we're targeting. If anything, we may just be continuing to set the benchmark even higher right now, just given the level of uncertainty in the environment. So really right now is a game of patience for us, and being able to continue to actively evaluate deals and stay patient, as we do think things are going to get worse before they get better again. And we do think that the price adjustment is starting to materialize, and we're hopeful that there'll be some near-term opportunities as a result of that. But we think the pricing adjustment could take another 6-12 months to really materialize. So for right now, we are just again making offers of seller financing to try to get some additional yield through that, as well as just really just actively pursuing deals, but being patient until the pricing really adjusts.
Yeah, looking for more of those off-market deals, I presume.
A lot of off-market deals, for sure.
So in a recent newsletter that you wrote, you mentioned that equity is less focused right now on forecasting IRR due to uncertainty in interest rates. Can you expand a little bit on this uncertainty and how it's affecting investment decisions in the commercial real estate sector?
Yeah, so the point I was making about equity not being as focused on IRR, I mean, everybody's always going to look at IRR, and everyone's going to have their IRR targets. That's a part of what we do, of course. But I think the point that a lot of people are making right now is that we can't really forecast cap rates in 5 years from now. We actually never could, but now I think everyone is a little bit more aware of that, because it's especially difficult when we're not really sure where rates will land and stabilize at over the in the coming years. So I think what most are doing is not necessarily looking at how does this pencil with an IRR if I just assume a similar cap rate to where I enter, or if I assume 50 basis points higher. They're looking at it more in the sense of, where does my stabilized unlevered yield come in? And usually most people have a target as to what they want to hit on yield on their all-in cost on the opportunity. So to break that into an example, say for some they believe that the long-term cap rates on mobile home communities are going to stabilize at 6%. Again, depends on the market widely, right? But we'll just say that's the forecast. Then usually to hit the IRR target, you're going to want to see you usually want to see like a 200 basis point unlevered yield at stabilization, meaning that if you spend $10 million for the property, and then another $2 million on the improvements, you're seeing that on your all-in $12 million, you're going to be able to get a yield without factoring the debt. Your return on investment would be equal to, say, 8% if you wanted to get an unlevered yield of 8%. And I think depending on the asset class, everyone has a general target for what they believe to be a safe unlevered yield. And I think the reason that's becoming more important is because they want to ensure that they have options when they get there. If rates don't decrease, they want to make sure they have a healthy enough spread to be able to refinance at that point in time, or be able to sell to a reasonable buyer at that point in time, versus just simply looking at the IRR. And I think as you get to the lower cap rate deals, that's where it becomes especially sensitive, as again, when saw buyers coming into multifamily buying at 4 caps with the hope of getting it to a 6 to then refinance or sell at a 4.5 or somewhere along those lines. I think those are the places where there's so much sensitivity towards that right now, because who's to say you're going to have an end buyer at a 4.5 cap when in today's market you're seeing rates in the 6%, 6 to 7% range for that same asset. So I think just building in that extra margin of safety and focusing on where they're going to be able to stabilize the all-in yield is going to help people feel more comfortable.
Okay. Looking right now at the equity side of things, what are you hearing about the current demand of equity investments into commercial real estate at this moment, and how have those been impacted by the current economic sentiment?
Yeah, so I think there's definitely a little bit of fear in the market with equity, and you look at a lot of money right now is looking at a lot of the high yield that they're able to obtain in the debt markets right now, whether people are buying treasuries or whether you're investing into different credit funds. We're hearing plenty of credit funds offering double-digit returns right now. So I think when that is your opportunity cost, I think people on the equity side seem a little bit more hesitant to go after something that has a low yield, lower IRRs. So I would say it seems like the equity market is probably looking for a little bit better of a deal on average than perhaps they were back when, again, they're going to be lucky to get 1 or 2% in their savings accounts or the debt markets, right? So I think that right now, because of that, there's a shift, and I think a lot of people are also of the similar mindset of just kind of waiting for things to maybe normalize a little bit, or to see some more adjustment, to be able to jump in and capitalize on those opportunities. But that said, I mean, there's tremendous amounts of dry powder out there. I can't quote all the stats of the big PE firms, but there are tremendous amounts of capital being raised and ready to be deployed and ready to pounce all at the same time. So it's not necessarily a contrarian viewpoint to be taking right now. And I think we'll have to see how much real pricing adjustment occurs because of the amount of capital that is sitting there on the sidelines ready to be deployed. So it's hard to say what things are really going to look like when we do start seeing adjustment, how quickly equity is ready to be able to jump in and start buying and seeing transaction volume increasing as a result. The other piece on the equity side, I mean, it's very, very personal, individualized, right? We still have a lot of investors that invest for the depreciation and the losses that are a huge benefit in the asset class that we purchase. So there's a tremendous amount of equity interested for those reasons as well, on more of the kind of retail individual investor level. And yeah, I mean, the equity is still out there without a doubt, but I would say that, from our discussions, it seems like everyone is being a little bit more particular right now, just maybe having a little bit higher expectations, just given where the market sits.
Okay, I think that's fair. On the debt markets, I know that these are essential for financing. Regional banks have been increasing their spreads, as we know. How does that impact our financing options, and how do you navigate those challenges?
Yeah, so I think the regional banks are probably one of the biggest threats that right now the alternative asset classes face in real estate. So when you look at the MH or the RV world, or even self-storage, or a lot of the different asset classes out there that are not sort of your big four food groups, a lot of them rely heavily on regional banks. And the regional banks right now are running into, I think we've seen more banks reach out to us than ever before fighting for deposits, and they're offering bigger incentives to be able to get more deposits. And I think because of the collapse of some of these larger regional banks, I think there's just been there's a new level of scrutiny going on internally at each of these banks. I think they're all looking at their balance sheets and trying to make sure that they're solid and they're protected. And I think as a result of that, they're being more thoughtful on any of the deals they do decide to lend on. They're trying to increase their profitability. on the deals that they're lending on, especially now that, again, they're having to pay out more for their deposit accounts. So I think the regional banks are something we have to really monitor closely. And I think that, again, could provide opportunity if there is a shortfall in the regional banks in the near term, as, again, as capital dries up there, more people may be looking to sell, but you're going to have to go in with probably lower leverage to be able to purchase in those events. But I mean, it's not good for anyone, generally speaking. I think, it's definitely one of the bigger threats that, the alternative real estate asset types face right now is just the, pullback that we're seeing from regional banks. And I definitely think we're going to see it get a lot worse in the next 6 months or so.
Okay. Jumping a little bit into the acquisition side of things now. I know that in our asset classes, interest rates have been in the 6 to 8% range. How has this affected your approach to acquisitions over the course of this year?
So it's really the same theme, right? When we generally have a target yield, target debt coverage that we're trying to hit depending on the type of asset that we're looking at. And because of that, the yields are lower than they would be if we're paying the same price. Therefore, we have to adjust our pricing accordingly to be able to hit our target yield, hit our target DCR, hit our target IRR, stabilized yield, and all of the above. So yeah, it's definitely made, it's probably influenced us to have to offer, maybe, I don't know, somewhere in the 10 to 30% range difference, depending on the deal. But probably usually more like the 10 to 20% is probably somewhere around where we've seen pricing fall as a result.
Below the asking price?
Below where it may have priced at the peak, call it, if we want to say that as of last year. So asking prices, we see a very wide variance right now, and usually well below asking price on average, but 10 to 20 is probably off where we might have been when rates were 300 basis points lower. So.
Oh wow. Can you tell us a little bit more about the current acquisitions efforts that TRG is doing, especially the cold calling and direct mail campaigns, and how these aim to maximize high quality investment opportunities?
Yeah, so we definitely do a decent amount of cold calling. We generally have at least 100 calls go out each day, which is not a tremendous amount, but for what we do, for the space we deal with, it's more like quality over quantity. It's a pretty targeted effort, and usually we're fortunate to be able to line up somewhere around a deal a day, maybe every weekday, a deal that we were able to line up off market. So we see a pretty considerable amount of deals just by reaching out direct to owner, and that's definitely been a huge part of our acquisition strategy. We're running into similar issues there too, though. It's not like they're all ready to sell at their different prices, right? A lot of owners are still kind of stuck on previous pricing, or again, a lot of people we get in touch with, they're not really planning, they're not reaching out directly to sell, so they're just not. It might just be a timing issue. So, but it's great to build up a strong pipeline there. We haven't done direct mail yet, though it is something that's definitely on our radar for future, just to test it as another off-market strategy.
Yeah, absolutely. So I know that in the multifamily sector, a record number of delivered units has been reported over the past 12 months. So there's been a 27% increase compared to the preceding year. As a result, vacancy rates have seen at least a 1.3% rise compared to the same period last year. As we observe these shifts in demand, have you seen any in the mobile home or RV space as a result of increased supply? And kind of how are we adapting our operation strategy in lieu of that?
Sure. So I actually have some really interesting stats on multifamily, again, because that's where I got my start and still something we keep a decent pulse on. But multifamily, I believe it's as of this year, the deliveries coming on this year, for the first time, I want to say, are higher than the peak, which was previously in the 1970s. So when you look at the multifamily deliveries over the last 50 years or so, in the 70s, we saw just a tremendous amount of product coming to market. And that's why, as a value-add multifamily investor, the majority of deals you see are 70s. Everyone wants to be 80s and newer because of, generally the infrastructure. But the 70s are where the vast majority of deals are coming from for multifamily. Okay. And then as you go into the 80s, you have a decent amount of quality products still getting built, but then the 90s there's hardly any product, and then 2000s again you see it kind of creep up until 2008, and then it drops off again. So I don't know. I just think that's interesting to follow, just for people, because I know a lot of our listeners are active multifamily investors or passive multifamily investors, and it's just something to be aware of. Is that now, like in 20 years from now, you're going to see these years be they're going to see enough product that was built in these years similar to the 1970s. So we'll see. I'm really curious to see what happens, and if the level of new builds keep up. I imagine it is slowing down, but again, not something I'm ultra tuned into as far as what we can forecast moving forward. But just neat side note. But diving into MH and RV and how that's impacted, I don't think it's had a big impact. I mean, generally the people that buy a mobile manufactured home from you and move into your community, I always like to think that they're not necessarily looking at an apartment as the alternative. It's usually looking at a single family house as the alternative. And there's still a massive shortage on that side of things, and there's still a massive shortage of even rental units across the country. So I still think we have just a ton of demand there. And from the last I've heard, the supply in the industry is still more MH getting decreasing supply because they're either getting closed down or they're getting built to something else for highest and best use than there is new product coming online. I know there are a lot of people talking about building, and there aren't as many that are actually doing it yet, but you're seeing a lot more new build than ever before in the last few years. But I still think we have a negative net supply year over year in the MH space, which gives us a really healthy level of demand, especially considering it's generally the most affordable form of living. Yeah. And then on the RV side, you're anecdotally, you're still going around and often hearing a lot of people that are still just getting to their plans of being able to move into their RV and go full time, and you're seeing a lot of millennials that are still eager to get a work from home job and be able to live in an RV, and I think Starlink has been a huge help for that too, helping improve the Wi-Fi availability for these people that travel from the road. So still seeing a lot of demand for that sort of full-time RVer. And I think that would be the most relevant form of demand as we're looking at multifamily to compare. So you're definitely seeing a lot of demand for that, and the RV side we'll hit on more in terms of what we're seeing in the markets, but it's overall been pretty healthy.
So there's still a strong demand for affordable housing, and then in terms of the RV space, just to kind of sum up what you said, a lot of early adopters came in and kind of adopted the RV lifestyle, but there's still a large subset of the population that kind of was chewing on the idea and is now trying to work their way into it.
Yeah, I think one of the bigger risks is a lot of these companies that are switching back on their work from home policies, right? So as companies are starting to push back and you're seeing less of the work from home opportunities, that's probably one of the bigger threats when it comes specifically to sort of your full-time RVer that I'm referencing in this case.
Okay. So what are you seeing in terms of asset prices today versus peak prices last year?
So it's tough to say, and obviously super dependent on the asset class and even the size of the deal that you're looking at, because that might impact the type of financing you're going to put on it. But if we're just speaking really, really broad stroke, I believe according to Green Street, the all property index, so all institutional quality commercial real estate, I think we're down 16% from March 22. And I've seen a few references to, say, the multifamily sector that's put the benchmark at around the 12% mark since the peak of last year. So looking at that seems pretty on point with what we're seeing in the MH and RV space. Again, we have a lot less data to work with. I think MH has definitely stayed very, very strong because in times of turbulence like this, a lot of people are looking at what's the most affordable, recession-resistant asset type out there, and MH is usually one of the top contenders in that regards. So MH right now, I actually want to say it's probably pricing there is probably adjusted less than nearly any other asset class as a result of that. We're still seeing some really competitive deals that are getting purchased, and we're seeing cash purchases take place. So, they're not always as concerned with the financing markets, just given the level of demand you have with a lot of big institutions that are still just entering the space right now. So definitely feel like that asset type has remained stronger than most, but I don't want to say it hasn't seen a decrease, because definitely even in the last few months particularly, I think we are starting to see some adjustment. We're starting to see some deals that are actually getting closer to making sense for our model, which is a good sign for us at least. And then when it comes to the RV side, I definitely want to say RV's seen a bigger price adjustment. I would say probably closer to that, 16 to 20% on the adjustment. Again, total broad stroke, anecdotal, but wanted to just share we have definitely seen that a lot of the listings coming to market there are trading well below where they're coming to market, which shows that I think a lot of the times the brokers and sellers are still kind of looking at this and bringing it to market at yesterday's prices, last year's prices, and the market is bringing them back down to reality, and you're not seeing as many of these crazy aggressive outlier buyers. There always will be some, but I think you're seeing a lot of people kind of really focusing on the fundamentals and looking at the RV space, making sure that they're really getting to a good in-place yield, or a yield that they can see that's really healthy in the very near future, and maybe a little bit more grounded in their assumptions, which is, I think, again, a good thing for buyers like us, that should help kind of level the playing field a bit overall.
Awesome. All right, so jumping into the operations side of things, I know that based on some CampSpot reports data that we looked at, most of this year has seen a negative 1% year-over-year bookings. And I know September through November is forecasted to see negative 2 to negative 4%. How do you interpret this data?
Yeah, so the data from CampSpot, again, this is a small subset of the overall market, but we're dealing with such a fragmented market that there aren't too many really quality data sources. So we really like the monthly reports that they put out to their users to give just general insights on what they're seeing platform-wide. But the negative 1% bookings year to date definitely seems pretty in line with what we've been hearing, and looking at it trailing off to negative 2 to 4 for later months of this year is not a great sign, but I think it's something a lot of us had expected to take place, and I think it's just more of a reversion to the norm for the most part. I think we had a few years where campground owners were very fortunate to see just substantial demand of a lot of people traveling in their RV for the first time, and they couldn't stay at hotels, so we just had a little bit of a boom, and I think this is more of a reversion to the norm. But these numbers, granted, are still coming in higher than pre-COVID numbers were, so we still believe the industry has a ton of strength and should continue to grow at a similar pace to that which it's grown over the last 50 years or so. The data suggests that we have really steady single-digit growth in this industry since all the way back to, I believe it's like the 60s when they started to really track this data. So it's not really a hyper-cyclical business. It's generally a business that has been very steady, seen very, very steady growth year over year over time. And our expectations is that when you zoom out and we see what the upcoming years look like, yes, COVID probably advanced things a few years quicker than it would have went on a normal course, but we would expect that straight line will probably normalize over time. So, and we also are still seeing that, I think on our community specifically, I can only think of one that is down out of the 11 campgrounds that we operate that is down a little bit year over year, and that I think a lot of ours are up significantly year over year, and a lot of that is attributed to the fact that we're going in as value add investors, and we are usually purchasing properties that have upside that we can be able to create regardless of what the market does. So that's why our portfolio is not really going to be the best reflection of how the campgrounds across the whole country are doing, because a lot of our upside is a result of more of like a forced appreciation versus just simply what the market is doing. So I think again that's why I think you're always generally safer going after value-added investments that are not relying on purely just what the market's going to do in this space. It's a lot of it's seeing what the market's capable of and being able to create the the upside through effective operations. So. Yeah, that'd be my 2 cents on that. And I'd like to mention too that though the site nights are down a bit, most operators I've talked to that have seen a decrease in site nights are making up for that pretty significantly with the ADRs being up year over year. So generally the average daily rate has been higher across most campgrounds, and that's you're probably just seeing some of the occupancy decrease is probably just a little bit of price sensitivity being realized with the higher pricing that they're charging. So it's always hard to really figure out how much to attribute to what. But for most people that I've talked to, they're still up year over year, just because the higher ADR has helped offset that. Yep. One interesting stat that I recall from the campsite report is the recreation.gov traffic is up 4% year over year, which would mean that there's probably more availability at state parks. So as the state parks, either if they expand or if people are not camping quite as much, there may be more availability for people to start booking state parks, which definitely has competition and definitely has an impact on the private sector, because the private sector usually has significantly higher rates that they'll charge than a lot of the state parks will.
So it'll attract all those price sensitive customers.
Correct.
Yep. Okay. I know that we've been building up the back office and growing the overseas team. Can you tell us a little bit about any meaningful advances that we've had there?
Yeah, definitely. So a big focus of ours this year, again, this has been a year of just heavy operations for us in all regards. It's been great for us in the sense of having a chance to digest a lot of the acquisitions that we've had in the last few years and just pour in and build really solid foundation, or continue to build on the solid foundation for the operation side of things. So in the last 12 months, we've made some huge strides when it comes to beginning to grow an overseas team. We've mainly hired different team members in the Philippines, and the first leg of that was our call team. So we have a call team that helps us with all sorts of different calls, whether it's a maintenance call, a leasing call, our reservation call, which is probably the majority of our calls are people calling in to book a reservation at one of the various campgrounds. Yeah. We've really done a lot to be able to build this team out, to be able to allow the managers to focus more on just guest or resident experience on site, and being able to just expand what the managers are capable of by having them not be necessarily tied to the phone all day and having distractions come in from all of the different phone calls. So by being able to build solid team in the Philippines, we've put in great audit processes where we have monthly reviews and a bonus system tied to the monthly review process we have. We have, I believe it's 3 calls per agent getting reviewed every single week, and we have a rating system in place for each of them that bases them on the tonality used, the way that they've handled different questions, the quality of the overall guest experience, that kind of thing. So we really feel great about the sort of the overall framework that we've put in place with that team. Yeah. And then more recently, we've built out a really strong team that's been helpful on the bookkeeping side of things. And we have all of our bills, all of our accounts payable, accounts receivable being handled with a team that's been built out around a lot of really strong SOPs, also in the Philippines. And again, been super grateful for the team that we've been able to build there, and we are excited about continuing to really just build out a stronger and stronger back office for our team. Yeah. And I think everyone's feeling the benefits of that, from our on-site teams to the regional managers and so on.
Yeah, I think something we've discussed internally is the amount of money that was left on the table in the industry just from people not picking up the phone at these properties.
Yeah. Oh, yeah, definitely. I mean, there's one rule for campgrounds is always pick up the phone. And I think it's tough, though, when you have especially when you have a smaller campground that doesn't have the payroll budget to afford a huge support team, because, again, this is a competitive industry, and, labor costs are up across the board. So because of that, we find that it can be a lot of effort for the manager to be constantly there, constantly taking all the calls, because sometimes we'll have, and a lot of our campgrounds get 100 plus calls a week, right? So when you just factor that the average call is 2.5 minutes long, and you get 100 calls coming in, and then you also have to factor in the call disposition lag time that might take place. So maybe you can take 30 calls per hour, then that ends up being several hours of the manager's time just fielding calls, because they're happening at all different random times of the day. And a lot of the times, a lot of the calls happen, you'd be surprised how many calls we get after 5 o'clock when the managers are clocking out. So by having this team in place, we now can take calls 18 hours a day, and the managers, they're just freed up tremendously off not having to answer the same questions again and again, and we have a team to be able to help support them in that. And then obviously they can loop in the manager if there's something really sensitive that the manager needs to deal with on site. So I think it's been really helpful from that side of things.
Yeah, it's great. Is the goal to ramp that up from 18 hours to eventually a 24-hour call center?
I think we probably will, yeah. We haven't had a huge need just yet, and we're heading into what for most of our places is more of a down season. So I don't know what the timeline is going to be on that, but I think eventually we definitely will have 24-hour support in place for sure.
Great. From a rent perspective, how are you approaching rent increases going into next year? What expenses are you also most concerned about?
So for rent increases, or for the campground, just general revenue management, looking at next year, this is really where we start budgeting, usually September into October, and usually we aim to have all budgets totally finalized by end of October. So it's something we're actively working on right now. But a lot of our properties still have a pretty heavy amount of loss to lease. That's just a function of either not keeping up with the market, or it's a function of usually an acquisition, we're just behind the market. So it takes time to be able to to decrease the loss to lease to get closer to the market rents. So really for us, we don't have too many properties where we're looking at it and just trying to gauge what the market's going to handle on its own, because there usually is some component of loss to lease in place. So we do expect that, let's say on the MH side of things, I think our general revenue increase should probably be similar to the last year, I would say, on most of these. And we think that the rent increases industry wide are going to remain pretty strong there over coming years, just as the industry hasn't necessarily kept up with usually the pace that you've seen other forms of rent going up, like say apartments and things like that. Yeah. And then on the campground side, revenue management is a lot more of a fluid process there, where for the transient rates, for short-term rates, we're usually looking at it's all supply and demand. So we look at just every month we're looking at the income and occupancy by site type to be able to determine how the different site types are doing at different campgrounds, and just constantly adjusting pricing to be able to find that kind of sweet spot where we sit at a healthy occupancy level, healthy income level that we're generally targeting. And really for the campground side of things, we're more focused on just stability of revenue right now in this environment. So we're looking at a lot of long-term bookings, even a lot of our short-term rentals, just because anytime we have the opportunity to fill in someone either on a month-to-month or sort of an annual site agreement, we have a price there's always a price that makes sense to do that with. And we generally prefer that as a strategy right now, just to have the stability, one less thing to worry about, and to be tracking week-over-week performance. So we would definitely sacrifice a little bit of optimizing every dollar of revenue just to have the the consistency, stability that can come from having more long-term agreements in place.
Okay, yeah, I think that makes a lot of sense. Lastly, do you have any final thoughts on the current state of the market, and perhaps for any investor who's just been patiently kind of waiting on the sidelines for things like deal flow to increase? Do you have any final thoughts on any of that?
Yeah, I think the state of the market right now is definitely a waiting game. Definitely a game it's a good time to be patient. Don't feel like you're alone if you feel like you're not seeing enough deal flow. And if you are, seeing a lot of deal flow. Good for you, right? I think it's definitely. I mean, there are people out there that are still doing a pretty healthy amount of deals. I think overall the asset classes that we're investing into are going to be really strong over the long term. So I don't think it's something that you have to worry too much about the long-term prospects. But I think just being able to kind of hold your ground and know your standards as far as what your near-term criteria look like, and stick with that, because my general sense is that the market's going to adjust a bit more accordingly. So
awesome. Well, thanks, Dylan, for joining us again. That's all we have for today. Thanks for joining us on today's episode of Requity Insights. We hope that you found the information valuable and insightful.
Thanks for tuning in to another episode of Requity Insights, hosted by our team at the Requity Group. You can find recordings of all shows along with our opt-in form to set up a call and view future investment offerings on our company website, therequitygroup.com, also listed in the show notes.